Hey everyone, Taiwan Semiconductor Manufacturing Company is already up nearly 14% to start the year in 2024. But is the stock still a buy? I understand it is benefiting from the rising effectiveness of artificial intelligence, and demand for its semiconductor technology is absolutely soaring. So let's take a look inside Taiwan Semiconductor. Let's look at its growth rates, its profit margins, its cash flow, and its valuation to determine if this stock is an excellent buy for long-term investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
You can see over the last decade, Taiwan semiconductor manufacturing revenue has soared to 69.33 billion. That was up from around 20 billion in 2015. This is likely to continue growing as demand for semiconductor chips continues to soar from rising effectiveness of AI. TSM has proven to be one of the leading edge manufacturers of semiconductor chips worldwide. There are some geopolitical risks surrounding Taiwan Semiconductor, although I think that's going to be reflected when we look at valuation. Revenue growth, meanwhile, remains on track to continue higher as it continues to innovate with its next generation 2 nanometer technology expected to come out next year. Already its 3 nanometer technology is driving demand higher for TSM. The company's been able to innovate profitably. It has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. All right, so now that we've looked at what it means, you can look at its operating profit margin at 45.62%. That's up from 36% in 2015, and one of the best operating profit margins for companies that mainly drive revenue from hardware. Software companies can generate higher profitability because they don't deal with capital intensive industry like semiconductor technology companies, like hardware companies. TSM is impressive in that it's been able to achieve this, driven mainly by hardware. The next thing I wanted to look at is cash flow from operations to sales. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that we've gotten a closer look at what it means for cash flow from operations, TSM again with a phenomenal metric of 63.15%. This is among the best cash flow from operations to sales numbers of any company that I follow. I don't know if there's any company that beats TSM. I know Visa will be close. I'm not sure. I'll have to double check again, but this is an incredible number that's among the leaderboard of companies worldwide, demonstrating again, along with its operating profitability, just how good TSM is at doing what it does. It's the best in class in doing what it does, and that's hard to find for investors looking for a company that operates extremely efficiently. Looking forward a couple of years, for fiscal year 2024, Wall Street expects TSM to generate 22% revenue growth and 9.9% earnings growth. For fiscal year 2025, Wall Street expects 20% revenue growth with 22.8% earnings per share growth. And for 2026, the growth rate is expected at 12.8% with negative 8.3% earnings per share for 2026. Remember, this is a group of Wall Street analysts that follow TSM stock. They submit their forecast for what they think revenue and earnings per share will be in the next few years. And this is the consensus estimate among those analysts that are following TSM stock. Remember, this is not guaranteed to happen. Nobody knows what's going to happen in the future, although Wall Street analysts that are following the stock have a pretty good idea in what revenue and earnings per share are going to be. They work closely with company management to get numbers, to get hypotheticals, and then they derive their financial models and make their forecast. They're not always precisely accurate, but they do a pretty good job in forecasting revenue and earnings per share growth over at least the next 1, 2 to 3 years, right? When you're looking at 5 to 10 years, then it becomes much harder to forecast. But over the 1 to 3 year period, it's a little bit easier, although still not easy because it is in the future and there's so much uncertainty. But the lesser years you're looking at, the more accurate you can be. And the further along you're looking at, the wider your estimates have to be, because then you're working with many more variables that can go one way or another. And finally, valuation. Judging by TSM's forward price to earnings ratio of 15.35, the stock is on the lower end of where it's traded at according to this metric going back 3.5 years. You could have been buying the stock at a cheaper valuation, although for most of the last 3 or 4 years, it's been more expensive than where it's currently trading at. So all these things considered, I would say yes, TSM stock is a buy right now at these current prices for long-term investors. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.